Hello, today we are going to be looking at a little bit different than the usual. So this goes for accounting students, business students, and even business owners. Now, you can see over here we have assets, liability, capital, and the question mark is here as you can see. It's a very simple thing to see actually, but there is a concept I want us to understand behind this. Okay? Now, every business you see is anything you see in the business, be it property, be it equipment, be it motor vehicle, be it building, be it land and building, of course, then maybe furnitures and other equipment. That if you look at Dangote, for instance, you can see the truck, everything you see them as an asset to the business, right? Fine, you are correct. They are all assets. But this asset you see came into being as a result of capital and liability. They all came into being as a result of capital and liability. What do I mean? Now, if you see any business, just like I said, Dangote business, if you look at its assets, or if you look at any business you can think about, if you look at the assets, the properties, the goods, the services, whatever it is they have that you can see physically or maybe goodwill or thereabout. But basically, those ones you can see physically, they came into being as a result of capital and liability. What do I mean? At first, when you start a business, you actually introduce a certain amount of money to set up that business. As at that stage, you are still growing, you just started. So the money you have is enough for you to carry out the business, right? So, but as the business is going, as it's growing, you decide to diversify, you decide to enter into other business, you decide to expand. But this time around, your capital cannot is not enough for to be able to carry out this assignment. So you need to carry out, you need to incur a liability. And how do you incur a liability? You either go to a bank to collect loan, you either buy goods on credit, you either issue out shares to the public so that they subscribe. One way or the other, the business is growing and you need additional capital. That capital might not come from you, that capital might come from other person outside. In this case, that is where the liability come in. But at first, the accounting equation might likely be assets assets equal to capital. That is at the very beginning. Even if you look at this capital is still a form of liability because you are different from the owner. Looking at business entity concept, the owner is different from the business, right? So you are, if you are introducing money to the business, this capital represents you, and this asset represents what the business has, right? So now in this form, it's also a liability, just that it's a liability to an inner to from an inside person. Okay, but when you now come to the fact that you are growing and you need to expand and you now source for fund from another party, then that is where the liabilities will come in. So at the end of the day, the accounting equation says that asset equal to capital plus liability. That is the reason behind that. So even without having this at the back of your mind, even without having to store this in your memory, once you look at any business, any asset of any business, what should come to your mind is that that asset is made up of capital and liability, most likely. So now we have an asset of 5,000 here and a liability of 500. So it means what then is our capital? It means the asset minus the liability. This gives you the uh, capital. So it means this person introduced 4,500 as the capital, and at the end of the day, incurred additional 500 to be able to acquire this asset worth 5,000. Now in this other case too, the person here introduced this businessman or woman introduced 1,500, but then you can see that they have an asset of 6,500. So what might likely be the cost is because this business obtained loan from the outside, from a third party or so now we have 5,000 as the liability. Now in this case, you see that the asset here is unknown. So what you're going to do is that if this person introduced capital of 650 and there's a liability of 70, fine. It's possible that When you add these two together, you arrive at the asset. So it means this asset is made up of capital and liability. Without even cramming it, or without even trying to understand or trying to know the formula, at least understanding it will assist you. The similar fashion to this one also. So not this other two. Just did the drop down. So in this case, the answer will just be like the first one we did, where we have our asset is 1.5, the liability is 300. It means the difference is what the person introduced into the business. So this equal to this minus this. And I think it also go to the other one. So now with this, I believe if you have any question, please drop it in the comment section. It's very simple, as you can see, but it will assist us a long way if we have this concept, this background from the beginning, so that one we it will also aid our decision making, so we know the worth or the net worth of our business and the likes. Please subscribe to my YouTube channel. You can like my video, share my video. If you have any question, drop it in the comment section. Please turn on notifications so that you get notified whenever I make new videos.